Hi, it's Michael Farr from Farr, Miller and Washington. Markets at the beginning of 2015 have been very volatile, and the economic news hasn't been good. The key has been oil. Follow the price of oil, and you can follow the markets. Now, there's a lot of early upset at the volatility so far this year in prices. As I've often pointed out, nobody really minds upside volatility. It's the downside volatility that bugs people. We've had downside volatility and it's been bugging people. What's behind it? We saw retail sales really slow. And that means the consumer might be pulling back a little bit. When our economy is driven 2/3 by the consumer, that's a concern. The Federal Reserve is now looking for 2.75% GDP growth this year. That's a lower number than we've seen before. They're still saying they're going to raise rates in June or September. September would be earliest in my opinion, and I think they may not do it at all this year. There is no real economic growth. Producer prices came out this week. They were lower. Now, producer prices were up 1.1% for the entire year of 2014. So costs, when we look for inflation, there were no costs. Cost increases, 1% costs for the stuff that goes in to the stuff that gets made that consumers buy. When those producer costs go up, producer prices go up, we look for those prices and cost increases to be passed along to the consumer at some point. That's not happening. And the retail sales numbers show that the individual is really not buying in any sort of voracious way. The interest rate on the 10-year Treasury is now 1.8%. On the German 10-year Treasury, 0.4%. None of these are signs of a robust and growing economy. So, what we've seen is as long as the central bank stays at the table, markets do well. Central banks around the world are indeed ponying up, and we saw the Swiss bank remove their peg to the euro for their Swiss franc to the euro. It inflated, the euro fell. If you want to go to Europe, it's a pretty good time. $1.16 is what a euro dollar will cost you. That's as low as it's been almost, I think, in the past 10 years. So the trends economically are not really robust. They're not really awful yet, but it's our reason at Farr, Miller and Washington for owning high-quality stocks, for remaining defensive. Markets are up. We saw over 50 new highs in the S&P 500 last year. Remember my rule, buy low, sell high? This is not low. So if things aren't low and the overall economy, underlying economy, is showing less than robust growth and perhaps a little weakness, stay in investments that are safe, that are earning money, that have good good cash flow, and are not over levered. Good management matters too. If we can help you parse through some of these tea leaves, give us a call at Farr, Miller and Washington. And I have the great honor on February 3rd to be speaking at the University of Delaware with my friend and president of the St. Louis Federal Reserve Bank, Jim Bullard, giving the 2015 economic forecast. Last year it was my privilege to do that with Charlie Plosser from the Philadelphia Fed, and the year before with Jeff Lacker from the Richmond Fed. It is a great privilege to be able to do that with this caliber of central banker. I hope you'll join us. We have over 400 and some odd people signed up already. It is free, but we will run out of space. So please join us at the University of Delaware at the beginning of February. If we can give you any help at Farr, Miller in Washington, it's always our pleasure to do so. Happy 2015 from Washington, D.C. I'm Michael Farr.